It's the first week of March. Let's see how it's looking on the economic calendars for you traders with Bob Mason of FX Empire. This is the Midweek Wrap. Hello, Bob, and thank you for joining us today. Let's start with the calendars. It's the first week of the month. Is it busy as usual?
Been quite a week for the financial markets. We've seen the dollar rebound. Economic data at the start of the week, it was ISM manufacturing numbers, the market's preferred figures, that showed that the sector stagnated in February. That was to be expected, and it's yet to reflect the full impact of the coronavirus. Obviously, at the start of the week, we heard the promise of fiscal and monetary policy support. That moved on to the Fed delivering an emergency 50-bip rate cut on Tuesday. That was unexpected. The markets had been expecting the rate cut to come in the next FOMC meeting. Obviously, some pressure from the US government, likely to be off the back of some promise of fiscal support to ease the pressure on the Fed to continue to cut rates. Economic data through the remainder of the week. We got the market's preferred ISM non-manufacturing numbers later today. How forgiving are the markets going to be? You know, if we see similar numbers as we saw with the market figures and a contraction in the sector before we really get to see the full effects of the coronavirus, then, you know, surely the dollar's going to take another tank and risk appetite should hit reverse and we should see demand rise for US treasuries. Looking at the end of the week, we've obviously got non-farm payrolls and wage growth. Again, a lot will depend on the news wires, the coronavirus spread across the US, and obviously what the US administration has in store to offset the effects, and whether the Democrats will actually allow Trump to do what he really wants to do and support the markets. Looking at the euro, last week we heard ECB President Lagarde talk down any ECB support. That's shifted this week. We saw Deputy Leader of the ECB talk up the support from the ECB likely to come should the need arise. The need's definitely there. I mean, we look at the data, manufacturing PMI numbers at the start of the week better than expected, but still pretty woeful. Germany was at the bottom of the table once more, and obviously Italy was struggling, and that's going to get worse with the virus and the impact on the economy. Later today, we've got retail sales figures out of Germany and the Eurozone. That's going to garner some interest, as will the Eurozone's composite. But again, you know, the promise of fiscal support from the likes of Germany and monetary policy support from the ECB, and the market's going to look beyond February figures, and we're going to need to look at March, April to get a sense of how bad things are in the wake of the coronavirus spread, you know, and will fiscal support actually come, and will monetary policy support be enough to offset the effects. For the pound, obviously we've got markets thinking that the BOE is going to also support. Yeah, they're likely to cut. BOE Governor Carney spoke yesterday to lawmakers saying the Bank of England's ready, but they're unlikely to make a move until it's really necessary. Economic data out of the UK suggests the necessity is not there just yet. Obviously, there's plenty of uncertainty for the UK economy. We've not just got the coronavirus and impact on, you know, obviously global trade and beyond, but we've also got Brexit and trade negotiations ongoing. So the BOE will likely need to take a little bit of care. And the good news is we've got the autumn budget next week. So, you know, if the British government does loosen the purse strings, then that should ease pressure on the government. On the data front, today's service sector numbers out of the UK should have a relatively muted impact, barring a particularly dire set. These are finalised numbers, and there's no stats through the remainder of the week. So coronavirus news, talk and updates towards the autumn budget, and obviously Brexit chatter to be the key drivers.
A lot of data for our traders to process, but at least the stock market is recovering. In the meantime, how's it looking for the commodity currency countries?
For the commodity currencies, what a week. With the spread of the coronavirus, and when we look at China's manufacturing and service sector PMI numbers from the weekend and this morning and Monday, that's pretty dire. Both Caixin's manufacturing and service sector PMIs hit record lows. We saw levels that weren't even seen during the global financial crisis, reflecting the stark effects of the coronavirus and the quarantines and city shutdowns and the impact that's not only going to affect the Chinese economy through the first and second quarters, but across the region and beyond. Amazingly, the Aussie dollar, the Kiwi dollar, both found support. That's coming off the back of promise of fiscal support from governments, from the G7, and monetary policy support. On Tuesday, we saw the RBA cut rates. That came off the back of comments from the Australian government promising fiscal support. So we didn't see the Aussie dollar take a slide back to sub 65 levels. We saw the Aussie dollar on the move. That coming off the back of better than expected GDP numbers this morning, and it's pretty bullish for the commodity currency. That is assuming, of course, that governments pull out all stops and deliver on the promise of fiscal support and don't delay the delivery. RBA's obviously already delivered. The Kiwi dollar is expected to also get the benefits of monetary policy support. It's unlikely the RBNZ is going to stand pat after the RBA cut, particularly with New Zealand's economy reliance upon China on a trade front in particular. And then there's tourism as well, which is obviously going to hurt the New Zealand economy. So through the week ahead, stats out of New Zealand are on the lighter side. There's nothing really to consider following this morning's housing consent numbers. For the Aussie dollar, obviously after this morning's GDP numbers, we got trade data tomorrow and retail sales figures at the end of the week. There's going to be some forgiveness for any weak numbers. Obviously, monetary policy support and fiscal policy support is expected to provide some upside in the months ahead. How bad is it going to be? We don't know yet, and that's really why the markets are, ricocheting from ups and downs and lefts and rights. Really, I mean, it's quite volatile out there. For the Canadian dollar, we got the Bank of Canada in action later today. The Fed made its move early. That kind of leaves the Bank of Canada in a corner, and expectations are that they'll have to cut rates later today. Economic data hasn't been particularly great. The only saving grace for the loonie this week has been an uptick in oil prices, driven by a promise by OPEC to cut supply to meet the lack of demand stemming from the spread of the virus. So choppy week ahead. We're seeing the commodity currencies on the rise early in the week. That could reverse, however, should sentiment change towards whether the governments really will deliver on fiscal policy support over the next month or two.
A busy week for the commodity currencies, but how's it looking for the Asian giants, the Japanese yen and the Chinese yuan?
Start to the week for the Asian currencies as well. If we're looking at the Japanese yen, no one's particularly interested in the data. Obviously, it's all about risk aversion and sentiment towards the economy. Bank of Japan Governor Kuruda spoke at the start of the week and really got the ball rolling on the monetary policy support front, assuring the markets that the Bank of Japan will deliver liquidity to the financial markets. That's really, they're going to need to step up, really. We've heard the Bank of Japan assure the markets of monetary policy support throughout last year, and they really didn't deliver despite some quite dire economic data. Probably kind of lucky that they held back using the last bits of ammunition they've got left, if they've got any, because they're going to need it now. So let's see what the Bank of Japan delivers. There's a little bit of apprehension in terms of what fiscal policy support there's going to be. Obviously, last year's sales tax rate hike, that's left the government in a bit of a predicament as well, because consumption is going to be particularly dire. So are they going to reverse the sales hike, or are they going to deliver something else that's going to get shoppers spending again? Something's going to be needed. So support from both the Japanese government and the Bank of Japan are going to be needed. We're expecting economic data out of Japan to be quite dire in the next couple of months. For the yuan, it's almost a safe haven, really. We're seeing the yuan on the rise. Obviously, the coronavirus is starting to abate in the country. It remains to be seen whether that will stay as it is and continue to abate as factories reopen and people go back to work. So there is a little bit of apprehension there. So let's see what happens. Obviously, the Chinese government was quick to deliver support, as did the PBOC. So we can expect them to continue to provide support to the markets, which should continue to deliver some upside to the Chinese yuan, particularly when you're considering the fact that, obviously the likes of the US dollar on the back foot with, the Fed delivering monetary policy support. Will they deliver more? We're yet to see. But the PBOC will more likely do so, as will the Chinese government. So the Japanese yen and the yuan in positive territory. The yuan in positive territory in spite of the worst PMI numbers in history this week for February. And March numbers aren't going to be much better. So let's see whether the government's delivered on their promises. That's going to be key to risk appetite in the coming weeks.
Well, that's all for today. Thank you for joining us, Bob. That was the midweek wrap, and we will see you again next week.